Hi, everyone. Thank you for joining us today. I'm Marche, the webinar director here at Advice Chaser. Before we introduce our guests and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. I'm thrilled to bring you our educational presentation today. Attendees are muted, but we do encourage you to ask questions using the chat box. The presenters will answer those queries during or after the webinar today as appropriate. And if you ask a question in the chat box, go ahead and leave your phone number as well. If we can't get to your question during the event, we'll make sure someone reaches out to you after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. So I'm so excited to introduce you to today's guests. Today's moderator is Daniel Baumgartner, and he's the founding partner of Terra Nova Asset Management, which is established in 1998. He and his team manage portfolios for high net worth individuals, emphasize personal relationships with their clients, and have a deep commitment to making a sustainable difference in their financial lives by designing investment strategies which put their interests first. So Daniel, why don't you come off of mute and say hello?
Hello.
We're glad to have you here today. And Daniel will be moderating, watching your comments in the chat, and making sure that we get to those. I'd love to introduce you to today's speaker. Josh Kanter earned a bachelor's degree in economics and political science from Emory and earned a Doctor of Law degree in 1987 from the University of Chicago. Following several years in the legal space, Josh decided to focus on his family business, where he currently serves as president of Chicago Financial, Inc., a single family office overseeing a complex organization of trusts, investment, and philanthropic entities for a multi-branch and multi-generational family. Through Josh Kanter Wealth Advisory Services, Josh's goal is to provide thoughtful, personalized family business and legal consulting services to his clients. He is also the co-founder of Leaf Planner, and Leaf Planner is a solution to develop your own personal family owner's manual. It provides a family with a single source document that will help identify, organize, and communicate with family members and advisors about every aspect of a family's human, social, and financial capital in a holistic and meaningful way. And I'm going to go ahead and stop my sharing here. And Josh, I'm going to let you share your screen, and we're excited for today's webinar.
Well, let's see. Hopefully
it's working.
Got
great.
That over there. Excellent.
Yep.
And hopefully I'm not the only one who's always embarrassed to hear themselves talked about. So thank you, Marche. Thank you, Daniel. It's great to be back, and I appreciate being able to come back. Obviously, Marche just gave you a quick background on, or a quick review of my background. The only thing I guess I would add to that is just in terms of, I'm not going to run through anything about my resume really. What I think brings me to this work and to the idea of some of the things we're going to talk about today, and I guess in a minute we'll talk about what we're going to talk about, is, as she said, I've been a practicing lawyer, primarily in the transactional space, working with families. I've kind of been a student of the family office space and the multi-generational wealth space for the past 20 or 30 years. Obviously, I've been a family office executive, as Marche just indicated, and I've been a consultant to other families of wealth and working with them through some of these same issues. So I come at this with obviously my own perspective, but a lot of experience in looking at what other families have been through. And thank you again for having me back. So today's presentation is really a continuation of a series that we started recently. I think you'll see a link at some point to the first part of the presentation, and we'll get that link if you didn't get to join us for that. This is really a presentation about inheriting everything except money. It's really intended to be about all the things that many of us consider or talk about as kind of the soft side of inheritance, or the soft side of a legacy. And for that, that's really the area that I like to spend my time in, and really thinking about everything except for a family's investment. So that's kind of what we're gonna. Sorry, I just saw a chat pop up and it distracted me for a second. That's what we're gonna be talking about today.
And I just put the link in the chat, and it's also here on this screen. And
Perfect.
just so people know, Josh, I know we've talked about, it doesn't matter if you haven't seen part 1 yet. This is still very valuable information.
Yeah, these are really disconnected in some sense. They're related but disconnected. So definitely not important that you've seen part 1 and vice versa. And if you can hear my dogs in the background, I apologize. So let's talk for a second about where we've been with part 1. So in part 1, we really talked about this idea of what is family dynamics, governance, and education, why it matters, what are areas of risk that families of wealth have to be looking at. And then, as I described in that part 1 discussion, really the core of that to me is the family meeting, and what are some of the topics that families really try to tackle in that family meeting, whether that's family roles and responsibilities, financial literacy, a topic we're going to talk a lot about today, things like building families' human capital. So all of these different kinds of things. And again, if that's of interest to you, I'd encourage you to hopefully go back and take a look at part 1 of this series. Today, where we're going to go is really diving a little bit deeper into this idea of what is financial literacy, how do we get it, why do we want it, why do we want to make sure that our heirs have it, and then also looking at this question of how do we identify blind spots, how do we do better planning for ourselves, and then, as Marche mentioned at the beginning, and really what this leaf planner concept is about, how do you build a personal owner's manual for your family? I like to joke you get an owner's manual with a toaster and not a kid. That's not my joke. We've obviously all heard that. And I also would say you get an owner's manual with a toaster, not a kid, and not a family of wealth either. And so it's really about how do we collect all this information? How do we collect the things that rattle around in our head? And I'm going to talk about that in a little while. So I won't dive too deeply into that right now. For financial literacy, part of what I really want to talk about is why is this important? And again, much of what I talk about in this whole space, because it is the soft side of your wealth, is why is this stuff important? And in the financial literacy case, the bottom line is high schools don't really teach this. Very few do. I think if you can see a statistic here, then in 2018, only 17 states in the country required some level of personal finance be taught in their high schools. In 2011, it was only 13. So it's getting better, but it's still drastically behind what it really ought to be. People are coming into this space and they're really unprepared. So our goal is to make sure that people, families of wealth in particular, are really looking at this idea of financial literacy well beyond, even if there is a high school program, quite frankly, or a college program, well beyond what those programs are intended to cover. And then I want to look at a little bit about what is this idea of financial literacy itself. What are the kind of topics that you want to be thinking about covering with your family? And obviously, these are very family dependent. They're very age dependent. As you can see here, they're very age and education appropriate, right? You don't necessarily want to go in and expect a 15-year-old to understand the same thing as a 45-year-old. And frankly, even the 45-year-old artist understands things in a different way than the 45-year-old lawyer or financial executive. Not pointing to myself as though I'm 45. I'm pretty clearly not. So I look at this in lots of different subject areas, and there's some overlap here, as you can see. But, excuse me, it may be teaching family members about investing and learning to invest, or what things about investments. And that might include things like the effect of compounding, the effect of recovering from losses. If you've ever, most of you probably are well aware, but most people don't really think about, well, if I lose 50% in a stock market correction, it takes 100% to make that back, right? This is not it's not an even split there. So making sure people understand that, making sure people understand the impact of what many of us refer to as leakages, the impact of taxes, the impact of advisory fees, the impact of interest costs, and all of these different things. Financial literacy can also be talking about different kinds of legal entities. What are really the differences between an S Corp, a C Corp, a LLC, an LLP, a sole proprietorship, all of these different things that have, they exist for a reason, of course, right? And how can we get people to understand why would you use one over the other? In what situation? What are the tax consequences to that? What are the legal liability consequences to that? And making sure that families have some understanding of that. Do families understand how to read a financial statement? They don't necessarily need to be the CFO of a company, but they're in charge of a family balance sheet. Do they know how to read that balance sheet? Do they know how to read that income statement? Do they know enough about budgeting and financial planning? Can they really manage their own lives? Can they work with their advisors to look at financial planning and say, these are my objectives for the course of my life and for my family? Do I have obviously the means in which to do that? And are my investment, is my investment structure set up to achieve those goals? We want to talk to people about taxes and make sure they understand different types of taxes, different types of tax forms, so that they can talk. Again, they don't have to be able to fill them out, but they have to be able to have an intelligent conversation. So if you have a family that has a number of partnerships, then you should understand what a partnership tax return roughly is. Again, you shouldn't necessarily have to fill it out, but you should understand what these different things are and how those different types of taxes interact with each other. So things like that. Insurance basics. Many of us obviously have the easy ones, right? Life insurance, homeowners insurance. Maybe we've had kids who have gone off to college and rent an apartment, have renters insurance, health insurance, dental insurance, eye insurance, all the way to the more esoteric things like directors and officers liability insurance, employee practices insurance, long-term care insurance, all of these different things that people, again, should understand and think about. And then I'm going to come back to that in this idea of looking at blind spots and owner's manual as well.
Josh?
Yeah.
So we have a question here. What have you found is the best venue in which to teach these kind of financial concepts? A class, a family meeting, an internship? What is your thought?
Yeah, I think depending upon what else you're doing in your family, I mean, classes are great, obviously. Some of this can be, I think the family meeting is the ideal kind of context if you have a family that can undertake this kind of work and really establish a multi-year curriculum and focus on this kind of education and working with your different advisors. Maybe it's bringing in an insurance advisor to your family who can do that insurance piece. Maybe it's bringing in somebody like Daniel who works on the investment side who can really help a family understand some of these investment concepts and talk about asset classes and diversification and the importance of these issues. Maybe it's going to a local community college and taking a class in some of these things. Some people can pick some of these things up just by experience as well. So perhaps you've got an older person in the family who needs to get some of these skills. Maybe they're my age, but they haven't been involved in this kind of stuff. And so they go join a board of a local arts museum or whatever it is that they're interested in and involved in. Maybe they get involved in the investment committee and you can pick some of these things up, just by actually going and doing the things that you want to do in your day-to-day life. So lots of different ways to do it. I think it really depends on what works best for the individual family member and that family. Thanks for asking that. And by the way, let me say, I love having the questions interjected as they're appropriate through here. So if you do have questions and you're out there in the audience, please throw them in the chat. I really encourage you to do that. That makes this certainly more interesting and interactive for everybody. So anyway, lots of different types of financial literacy topics here. This can be, again, you can get a very surface level to some of these things. This is not to suggest that people all of a sudden need to become investment experts or tax experts, but the idea in preparing heirs who are going to receive some kind of inheritance or have to function in life, really, it doesn't even have to be about an inheritance, is that the more they can have a basic understanding of some of these things and be age appropriate again and kind of education appropriate, that they can then have an intelligent conversation with the family's advisors and be a participant in that conversation, which I think is a really important aspect of being an engaged owner of the family and engaged steward of the family as well. So the next thing I really want to touch on then is this idea of identifying blind spots. And then we'll get into the idea of the owner's manual as well. So what the idea of identifying blind spots is really centered on the age-old notion of you don't know what you don't know. And the first part of that, of course, is admitting that we don't know what we don't know, which is pretty difficult, especially for some of us. But once you can do that, then for me, this whole idea is that enterprising families really seek to explore and consciously choose to address or not address. And sometimes it's not addressing something. Not addressing something, of course, it's the whole action or inaction. Inaction by choice is in fact an action. And so our goal is to make sure that families are being very deliberate about the way that they're looking for, identifying, and addressing what we refer to as blind spots. For me, I kind of categorize them in different buckets. As you can see here, it doesn't really matter how you think about it. I mean, this is just a framework that works for the way my brain works, but everybody's brain works obviously a little bit differently. I think about blind spots in the idea of legacy planning, tax, legal, insurance, and risk review, family and kids, household blind spots, retirement investment blind spots. And I'm going to touch on some of those as we get a little bit further into this. The idea then is to think about what are your blind spots? What are the costs that really go along with those blind spots? And how do we both solve them, and what are the solutions to that, right? So we obviously have blind spots in things like estate tax, where we maybe aren't planning as efficiently as we could, or income tax, where again, we may not be planning as efficiently as we can. Maybe it's really important that we be looking at maximizing capital gains and not ordinary income, or whatever those different income tax issues are. Maybe we haven't really looked, again, at insurance. Some of these things you can see there's the tie between financial literacy and blind spot review in the Family Owners Manual. That's why we put these topics together. They really kind of go hand in hand. Maybe it's a missing insurance kind of element, or legal issues, or household issues. Again, all these same kinds of things. But there's really hidden costs to these. Some are truly economic. If we don't plan for estate taxes or don't plan efficiently for income taxes, there's a true economic cost to that. Some of these are much more, again, on the soft side of things. Are we creating a situation where there's family disharmony because we haven't really planned and looked at these blind spots? Are there unexpected consequences? Are there lost opportunities? Are there unintended consequences, tax inefficiencies, et cetera? And how we look at solving some of these things is, whoever your advisors are, is making sure that they're really deeply getting to know you and your family. How can they help you with this blind spot review? How can they use their expertise to go down that path, to help you look at risk assessment, to kind of audit and stress test your planning, to be quarterbacking all of those advisors, to make sure that your estate planning lawyer knows who your insurance consultant is, or whatever these, the different players are that are in your sphere. And again, I'm going to come back to this idea of information collection in owner's manual, and using the family meeting as a context to being able to give that education to other people within your family. The lenses, I look at blind spots, and there's a lot of stuff on the slide, so I apologize, and there's going to be 3 of these coming up. I only say this because there's a lot of different lenses through which you can look at this. And so again, for me, it's what's the lens that makes sense to you and your family to think about this. So if I look at this through what I would consider the blind spot lens, then I'm going to look at your tax and your legal and your insurance structuring and planning. And have you done all the income and estate tax planning that you should? This box on here saying an after high school packing list. And again, we'll talk about that in a little bit. But the idea is maybe you've got a child who turned 18. Have you prepared a will for them? Have you prepared a HIPAA release? Because if you send them into the world or off to college, no medical professional is ever going to talk to you again about your child if you don't have that HIPAA release. Have you looked at your different risks? Have you looked at your trust and trustees? All these different kinds of things. Moving over in your household, maybe you have a housekeeper, maybe you have a handyman, maybe you're in a situation where you have an estate manager for your 3 properties located throughout the country or the world. Have you done background checks? Have you signed confidentiality agreements? Have you thought about retirement for those employees? So again, this is all scaled to the type of family that your advisors are working with and your particular family. So it may or may not all be applicable, but it's really, again, how do you look at all these different things and say, where are those blind spots? And again, I'd say action and inaction are choices. Maybe you don't choose to do a background check on a household employee, but the fact that you thought about it and didn't do it is at least a choice. You're making that affirmative choice and that proactive choice. How do we look at blind spots in the retirement and investment context? And this is one that obviously falls a little bit more on the hard side of life than the soft side of life, but is really important. How do you look at all of your different investment managers and make sure that you're not overly concentrated? Are you doing the data aggregation and reporting that you should be doing to make sure that you're not overly concentrated, because it turns out that every one of your managers is heavily loaded into Apple or IBM or Microsoft or whatever it is? Have you looked at whether you have an investment policy statement that's guiding you through making sure that you don't make important mistakes about diversification or other things that matter to you? Have you looked at long-term care insurance? And if you've looked at long-term care insurance, for example, and said, I think I want or don't want long-term care insurance, but now I'm going to marry that with my wishes, which is that if I become ill or incapacitated, I want to be cared for at home. Have you matched that up to figure out, how am I going to pay for that? How's my family going to pay for that? Because now, by definition, I'm ill or incapacitated. I may not be a participant in that conversation about how to implement my wishes. So how do I look at those kinds of things? Here, you'll continue to see blind spots around family. Are people properly educated? Do they have the communication tools they need? Some of these are things we talked about in part one, which again, I'd encourage you to go back to part one and think about this idea of family dynamics and governance and education. Have we thought about the role of spouses? Have we thought about the use of prenuptial agreements or postnuptial agreements? Has everybody in the family protected their credit accounts and simply made the decision to freeze their credit accounts or to get an IRS PIN or any of the things that can do those things? And have you really evaluated your advisors recently? And I say that because there are many, many instances where we find that people have outgrown their advisors. And it doesn't mean that you've got to push them off to the side, but the situation is obviously not uncommon where somebody's lawyer, oh, well, they were my fraternity brother and I've been with them forever. Or they're my financial advisor. And I was, I went to high school with them. Well, if you've now dramatically outgrown their skill set, that relationship can still be maintained and be an important relationship. But have you really looked at evaluating whether those advisors are giving you the advice that you need as you've gotten to whatever level it is that you've gotten to?
Josh, here's
Yeah.
apropos the topic of advisors. Here's a question: what are the most essential advisors that you suggest families have, and are those different advisors than the ones you have for your immediate family?
I'm a little unclear on what the question meant in the difference between those advisors to the family and then maybe to the nuclear family. If that means in terms of advisors around a multi-branch.
It probably refers to exactly that. Do you keep the professionals, I guess, as you determine whether the expertise is appropriate, or do you expand the group with which you're working? That's what I imagine.
Yeah, and it could be that you're looking at, a multi-branch, multi-generational family. So maybe there's a big bucket, and then there's obviously these buckets for each individual family.
Right.
I think coordinating those people is more important than using the same people.
It's also personality too, I think.
Yeah.
I think you need to feel, as a family, it's hard to get everyone to love one or the other advisor. One may work for this person and the other one that just repulsed by them and being extreme.
Yeah.
Right? So
I think that's really important. I think that's important when you're choosing things like trustees as well, that not a single trustee is going to work for everybody in the family. I say this quite frankly in the work that I do with families, when I'm often brought in by, say, a matriarch or a patriarch to have an initial conversation. And one of the first things I'll say is, I can't take this engagement and I can't really help your family until I've met everybody, and everybody, even though they're not the ones paying the bill, that everybody has said, yes, we're willing and interested in working with Josh. That if somebody doesn't get along with me or say, I hate that guy, then I'm not the right person. So let me help you find the right person. So I think, Daniel, that's exactly right. Those personalities are really important. So another lens, and you're going to see the same ideas around this, but another lens to look at the blind spot idea through is through that planning lens. So if you're planning around, again, income or estate tax or trust and trustees, have you left memos and letters of intent? We can all look at a trust agreement and say, well, okay, here's the, in the legal profession, we always say in the four corners of document, right, is what does this document actually say on paper in black and white? But a lot of things, especially when you're talking about inheritance and trust agreements and distribution policies, this relies on wishes, right? It relies on what was your real intent, and how does the grantor of a trust sit down with a trustee and a beneficiary and express those views. So we want to make sure that people have left things like memos or letters of intent to their trustees, have people maximize their annual gift exclusion and done 529 plans and lots of different things, right? It's just a question of what's right for your family, what's not, but making sure that you're looking at the totality of these ideas around blind spots. Structure and governance. How do we look at what's the right business structure? What's the right family enterprise structure? What's the right philanthropic structure? Going back to financial literacy, do people in a family understand the difference between a private foundation and a donor advised fund and a charitable remainder trust, and why you would use each of those in a philanthropic context and choose each of those, and which one is appropriate for your family, or is some combination of those appropriate for your family? So again, it's looking at these through that blind spot or planning lens. Philanthropy, again, same idea. Is that structure going to meet your objectives? Are you going to have the governance and process in place that you want for that? In a family office, obviously looking at structure is really, really important. Simplification versus complexity, tax efficiency versus less tax efficiency, all of these kinds of issues. And as you get further down here on this chart, you can see, again, multi-generational issues. Do people have the education they need? Have you thought about establishing a family bank? And I don't mean that in the context of, pillars and Greek monoliths, but have you created a place where people can come and say, I want to be a chef, and so I want to go to Paris for a year and study at the Sorbonne. I want to go to college. I want to go to graduate school. I want to start a business. What are the rules around that? How does a family access their financial capital to build their human capital and do these things that people want? Have you really thought about preparing for family properties? Maybe there's a timeshare. Maybe there's a ski chalet. Maybe there's a estate somewhere. Have you looked at what's going to happen to those properties? Have you thought about creating the governance structures around those things to make sure that families don't end up? We can all pick up the Wall Street Journal just about every other week and find some family that's blowing up because nobody thought about dealing with those communication issues in advance. So that's sort of, again, kind of blind spots there. And of course, on the investment side, your investment advisor is the best one to be doing this, but talking about what are those blind spots? Are you over allocated? Do you have an appropriate asset allocation? Do you have a mechanism for manager selection and review, data aggregation and reporting, as I said, all these different kinds of things. And finally, and I'll get off this topic, is the different lens, which is just looking through your family lens, right? Are you holding family meetings that really focus on this idea of coming together, working together, communicating together, establishing family values, using, again, your financial capital to build your human capital? All these things are things that we also talked about in that first part, but are really critical blind spots to be looking at. How do we avoid the shirt sleeves to shirt sleeves proverb, or how do we avoid that most families fail not because of tax planning and investment planning, but because of a lack of preparedness or education for family members? So how do we make sure we look at those blind spots and solve for them? How do we, in legacy here, how do you think about making sure that your family understands your family's history, the mission that your family may have? Was education important? Again, is a family bank a way to express certain values like entrepreneurship or education? Do you have, again, family property? So lots of these things, again, they're duplicative across these different lenses, but they're just different lenses in a way of looking at these different issues. So then that brings me, when I tie all that together, to this idea of a family owner's manual. And one of the things I love about calling it, as I said earlier, the family owner's manual, is that it's not just a parts list, right? If you go to your estate lawyer, which I would encourage you to do, by the way, go to your estate lawyer, ask for a checklist, and you're going to get a great checklist. And to me, that's, to some extent, it's a great start. It's important to know what the parts are. But if you got a parts list for your toaster, it wouldn't necessarily tell you how to use the toaster. Now, I hope most of you know how to use a toaster without the owner's manual. We've probably never read the owner's manual. But if you needed to, you'd have that owner's manual there. And it's more than the parts list, right? It's really, how does this thing operate? And that, to me, is what's important about the family owner's manual, and why I like that, using that phrase for it. But I happened to come across this quote from this woman, Chanel Reynolds, in her book. I hope that giving her attribution for it is enough. But I love this idea. I was standing by the foot of my husband's bed in the intensive care unit. I turned to my friend when I still couldn't get into my husband's phone and remembered that his will was drafted but not signed. I didn't know if the life insurance had been on auto pay. I hope nothing bounced, and I didn't know if he had disability insurance or not. And I said, oh my God, I don't know if I can swear on this webinar, together at all. So if that doesn't encapsulate where all of us end up when somebody unexpectedly becomes ill, incapacitated, or dies, I don't know what does. It was just, to me, it's the perfect quote of why you need this idea of a family owner's manual, and that I encourage it so much. So again, let's talk about why. It allows you to do more deliberate and better planning. It allows you to identify blind spots. It allows you to create this idea of a living, dynamic, single source document. It allows you to work better and educate your family and your advisors. And it provides a roadmap of important documentation, information, knowledge, and wishes in the case of your illness, incapacitation, or death. And we focus a lot on, well, either we have people who focus on, well, I'm not going to die. Okay, I could probably take some argument with you about that one. But most people, even if they're willing to entertain the idea that eventually we're all going to die, is people don't plan for illness and incapacitation. And yet one of the three is coming, well, one of them is coming for all of us. And the other two very well may be coming for us as well. So it's really important that we think about these things in kind of this holistic manner.
I do have one question for you, Josh,
Yeah.
in that regard, and kind of popped into my mind. And I know that I see that with our clients, of the many clients we have, a bandwidth of investors, and the idea of ego. Many people are there's a whole bandwidth of how people associate themselves with their assets and their life's work. How does that play into the even considering making an owner's manual? Because that exposes you in so many ways.
Yeah, I think it's a great question.
It's probably a topic for another time, but maybe you want to address that briefly.
Yeah, let me just touch on it at least. I think that one of the things that I find in going through this process with people, families, is that people will choose to use it in different ways, right? And there may be a family that chooses to use it in a very, I'll say I do, right? I use this very transparently with my family. I have another client who I just took through one of these, and who sat down with their, 4 older adult children, all launched, all doing their own things, and used it as a roadmap to educate these adult children about what was going to happen when this patriarch eventually passed away and these things were passed on to the children. So I do think there's an opportunity for it to be a tool that a family can use very transparently, very openly. But to your point, if somebody is still of the mindset that they don't want to be transparent, or they want to use it simply with their advisors, or really it's just I'm going to lock this away and nobody's going to see it until the day I'm gone, I don't recommend that, but that's still better. That's a way of translating everything that's in that person's head, all the knowledge that they walk around with, and doing it in a way that that will eventually, be used as a succession tool. One of the things I talk about when I talk about the Family Owner's Manual is that in families or businesses that talk about succession, and this is particularly true, I think, in the family office space, as you've probably seen, Daniel, but the family office space is kind of rife with people talking about succession, because typically you're talking about a small staff, one senior person, maybe a couple of senior people, and succession ends up being around the skill set and the person who has to come in and replace somebody who's leaving, hopefully on a planned basis, but maybe on an emergency basis. And we never really talk about the succession of information. And to me, that's what this is about. This is about the succession of information. And so in that context, I don't think it has to be for that ego-driven, likely patriarch, right? Let's be honest about it. It's probably the patriarch who's saying, I'm never going to die and I'm not telling anybody anything. Maybe we can get them to at least think about putting that information in the safe deposit box in a way that, when they're gone, there's this roadmap for them. But it's tough.
Yeah, no, right. Thank you.
Um, so also looking at this, I don't like to focus on, I really, all those different points I said of the why, the more and better deliberate planning and things like that are really, really important. But of course, it's hard to put numbers around how does that do something? So we end up looking a lot at what happens if you don't do this. If you don't do this, what's the real cost to doing this? How do we look at that? And it's hard, again, to put sort of hard numbers to that. But I think some of these are kind of interesting. Administering a complex estate is really hard. If anybody on this webinar has done it or not done it, trust me, I had to do it with a world-renowned trust and estate lawyer as a father. His estate tax return was 10,000 pages long. It was really not fun. It's a complicated process. You can see on here, the average time to settle an ultra high net worth estate is 42 months, 3.5 years of somebody's time that's going into settling that estate. 1,200 hours of an executor's time going into settling that same estate. And amazingly, if you end up inadvertently with a $15 million estate going into probate in the state of California, statutory fees could be $190,000. So if that's not worth a little bit of time to try to figure this out, then I'm probably not going to win you over to this process, but I hope that you'll look at that and say, okay, I get it. And those are just the hard costs, right? That's not dealing with the soft costs of what does this mean to my family and what does this mean to their peace of mind or my peace of mind that they're going to be both taken care of and know how to be prepared heirs and stewards of this wealth that I'm leaving them. So anyway, so that's kind of the idea of that. And so again, sort of bringing it all into a single document is you have this whole idea of the blind spot review, better planning, things that you may say, oh, I never thought of that. Or things you may say, and we get this a lot, oh, I knew that, but I never did it. And getting people to do it. Or as an organizational tool, how can you use it again for family and advisor education, better decision-making, comprehensive alerts to make sure that you're doing things, simplifying your estate administration, and even going kind of through a what-if process, which leads to sort of the audit. Have you sort of audit, not in the income tax way, right? That we all don't want the IRS knocking on our door, but have you internally sort of audited your estate? What happens if something happens to Uncle Pete? Have you looked at your planning? Have you looked at your organization? Have you looked at that education that's been done? And that kind of comes down to this idea of the personalized owner's manual. Everybody's is different. We've developed a process called Leaf Plan, but there's lots of ways of doing this, and you can start this in a lot of different ways. I want to give you an idea of, you still may be skeptical, so I'm going to give you a few ideas of why this is so important and the kinds of things that we find. So we typically refer to this, or I typically refer to this as your sphere of responsibility. I say that because people typically think in terms of my family. And if I think of my family, in my case, that's my wife, my 2 boys, and maybe my 2 dogs, right? And it's very, very narrow. I want people to think much more broadly. I encourage you to think much more broadly. So I believe in this idea of the sphere of responsibility. Well, what does that mean? Well, we found that people hadn't actually planned for pets that were really meaningful to their family. We find that people maybe are paying for a niece or nephew's education or rent or something else. And that's not in their formal planning, but they're in their sphere of responsibility and they want that perpetuated by their kids. But nobody knows that. It's not written down anywhere. Maybe there's a long-time household employee who nothing's been done for, and now I'm gone and I want to provide for that person. So there are lots of these things that we try to get people to think about, and I encourage you to think about, regardless of how you do this, that you think broadly about this idea of a sphere of responsibility.
I have a quick question from the audience. Yeah. And he's asking, at what level of wealth is this level of planning appropriate or required if high net worth, but not ultra high net worth?
Yeah, I think, so I would make the argument that everybody, regardless of wealth level, should be doing this. In my view, this is, you get today, obviously, a young professional starting on their career, they pick up a copy of Quicken or Personal Capital or Mint or whatever it is, doesn't matter, right? And they know that they need to get their financial life in order. And I would argue to you that that same person should be starting this process because our lives only get more complex. And so I don't think this is an ultra high net worth only space. Complexity comes in all kinds of forms and shapes. Obviously, maybe that's a blended family situation. Maybe it's that, in my case, quite frankly, I was handed this incredibly complex structure around our family because my dad was a trust and estate lawyer. It can be really anything. Maybe there's joint ownership of a family business. It doesn't matter whether that's a $5 million business or a $150 million business. There's still complicated issues that go along with ownership of that family business. So I would really say, unless you're going to die a pauper and leave no issues and no problems for your family, this is appropriate for almost any level of wealth. Going back to this idea that it's not just about death, is this idea, is your family knowledgeable about your medical history or the medical history of different family members? And why does that matter, right? Where do they know where to turn? Who are the doctors? Where are the records? Do they know really who to turn to find that stuff in an emergency and when all of a sudden it's important? Or are they suddenly now digging around trying to find, oh, well, who was that cardiac surgeon my mom went to, and I don't know, right? And all those kinds of questions. Travel and leisure, we think about it as fun, but there's a lot of stuff connected to travel and leisure. Maybe you've been a road warrior and you've put up millions and millions of frequent flyer miles. I can't tell you that I know, so this goes back to Marche, your disclaimer about advice. I don't know that this is still true. In the old days, when I was a boy, the airlines would not respect the inheritability of frequent flyer miles unless they were specifically identified in your will. So fine, if you've now been a road warrior and you've got 3 million United miles and you want to make sure that your spouse, your partner, your kids, whoever gets those, that's really important that be identified. And that's a really valuable asset that people are often overlooking. Maybe you've got a country club membership. What happens to that? Who's the real equity member if it's an equity country club membership? Maybe a vacation club. Maybe going back to, as I said earlier, maybe there's a timeshare or a ski home or a lake home. How are you planning for all these things and making sure that people understand what the planning is, how they're going to be protected, how that's part of your legacy if it is, or is it just being sold? How do the kids govern that? All of those kinds of issues that will come up and are brought up through this process of you putting your owner's manual together. Have you done everything necessary to avoid probate? And that's, again, using that California example, right? Avoiding that $190,000 statutory fee. But we found way too often, even people who are knowledgeable about real estate, all of a sudden we find out, oh, well, my home is in mine and my spouse's names. They haven't moved it to their revocable trust. Maybe they're in a state where probate is, California right now, by the way, is running 2 years in probate. So if you end up with a personal, it may not, forget the cost. If you end up with a house, a personal residence in probate in California, and you now can't sell it for 2 years with everything we know is happening in the housing market, perhaps that's something you want to sell right now at the height of the market, not in 2 years when a probate court gives you permission. So it's thinking again about those kinds of issues. Here is your family aware of the existence, substance, location of all your important documents. This is a little bit more checklist oriented, but again, very, very important. And again, let's talk about why. Maybe you realize that you've got an incomplete estate plan. Maybe all of a sudden you realize, oh, wait, I actually don't have a healthcare power of attorney, or I don't have a general durable power of attorney, or I don't have a HIPAA release for my kids that I mentioned earlier, or I haven't prepared a letter of wishes. Now we're getting a little past the checklist and to that soft side again. Have I ever looked at, frankly, a 706 estate tax return and understood what are my advisors and my family going to need in order to fill that thing out? It's a complicated form. Go look at it and you'll see, I mean, even if you use that as your checklist, it'll give you a way to say, hey, this is the information I need to make sure I'm leaving. Excuse me. And finally here, I think, maybe you're expecting an estate tax and does your family know how that liability is going to be met? We find clients all the time who are thinking, well, I've got plenty of wealth. Well, that may be true, but is it liquid? What if you have a very illiquid estate? Have you talked about how's the family going to meet that estate tax liability if you deal with a lot of illiquid assets? Are you covering that by insurance? Are you replacing that value by insurance? Are you leaving instructions to your family of, I have all these illiquid investments. This is how they can be liquidated. This is who you should contact. don't liquidate this one because it's going to be worth a fortune someday. I want you to liquidate these 3 things instead. I have a client who came to us and said, well, my kids will just remortgage or sell this particular property. And my first question to him was, well, that's great. What if it's 2008 and there is no remortgaging and there is no selling, or they're selling, but they're selling at a tenth of what this thing might be worth? Is that really what you want? Is that the situation you want your children in? And so that's the idea, again, of stress testing, kind of how you do this and leaving your family those ideas. I think I said last, and I guess I didn't mean last. So are your financial and investment affairs organized and in order in a way that will be meaningful if you're suddenly ill, incapacitated, or pass away? Again, simple things. Does your family know why and how you entered into and would unwind complex transactions? Do you have information about a safe deposit box, whatever it is, all your accounts? How do people get into them? Are your beneficiaries up to date? Think about the last time you updated your will. Think about the last time you looked at your brokerage IRA account, and is your beneficiary designation up to date? Maybe you have a donor advised fund. Have you ever made sure that you've got a successor donor advisor named at your local community foundation or Fidelity or whoever has your donor advised fund? Have you really made sure that all those things are in place? And so I'll end with, one of the things that I also have often done with families is say, okay, if you don't buy off of this concept yet, after everything I just told you, then get your family in a room and do a little exercise. And I don't know, maybe we'll find a way to post this somewhere or send it out. But get everybody together, no preparation, no questions in advance, and say, can everybody answer these questions? Pick it. Mom, dad, whoever, somebody just fell ill, became incapacitated, or died. Can everybody else in the room, or can someone else in the room unlock that phone, unlock that computer, unlock those other devices? Do we know the first 5 people we have to call? Not because we're emotionally torn up, but because we've got to get that, going back right to that question about who are the most important advisors, that we've got to get that insurance person on board. We've got to get the lawyer on board. We've got to get the investment advisor on board. Can you identify those healthcare professionals? Do you know each other's wishes? Can you access all of those accounts? Do you know who all the vendors are for, mom's house when mom is no longer able to do it? Do you know what was on auto pay? Do you know out of what account? Do you know who's got the power of attorney to take over that account? All on and on. Anyway, simple exercise that you can do. If you can answer all those questions, then, God bless you. If you can't, then you need an owner's manual. And I'd recommend that you think about that process. So I'm going to stop there, and I hope that's all helpful. I love this kind of work, and so I love talking about it, but I realize it may be like just glazing over for most of our viewers, but I hope that's helpful, and look forward to answering any other questions.
Somebody's got to do it. Here's a question. This is a lot of information, and in regards to the sensitivity of the financial information, how does one protect this information once you put it out there?
So I would say people have to, of course, adopt their own approach to this. If there's a family, if you're putting this information together, it may depend on where that information resides. For me, quite frankly, my owner's manual says to my family members, go find my Quicken file. It's on my computer, and here's the password to my computer, right? If somebody is using an investment advisor that's maybe doing all their data aggregation and reporting through Adapar, maybe it's saying, hey, call Daniel, and Daniel's number is this, and here's Daniel's picture, because probably nobody in the family has ever met Daniel. And so here's Daniel's beautiful picture, and this is what he looks like, and here's his phone number, here's his email, and ask Daniel to walk you through the information that's in Adapar. So you don't necessarily have to include the information that you don't want to. And by the way, with things like passwords, we often are not often, always recommending that people don't. 1, because they change, and 2, because that's obviously a very high security risk. So the real answer to that is to say, well, in the owner's manual, all of my passwords are on the yellow pad in the second drawer next to my desk, or hopefully in this day and age, all of my passwords are in 1Pass, LastPass, whatever system you're using, that you're pointing people to that right place. Now you've always got, that last kernel of information that you've got to decide how you want to protect. So again, honestly, in my owner's manual is my last password. So my wife and my kids can go figure it out. But I could understand some families that are more security conscious than I am and who might say, well, okay, I'm going to tell 3 people where they can find, that one password that's kind of the keys to the kingdom or whatever, however you want to look at it. So I think you have to just simply balance your own security sort of tolerance and the systems that you're using, and then further decide how to address those questions.
Yeah, I don't know if you addressed this earlier, but I think you may have some of the blind spots which are common that you find with working with clients. Is that, did you already review that?
Yeah, a little bit,
good...
but I do think, there some of these most common blind spots, I guess, that I would say, we're typically seeing is inadvertent trips to probate court and things that could have been done to avoid that. Really not planning around adult children. And that becomes a really important one to me. I mean, we all think about our children as our children. Or maybe even, quite frankly, because of the Affordable Care Act, we think, oh, well, they're not adults until they're 26. And now they're moving off of my health insurance plan or their school's health insurance plan. But the reality, again, is, you got to be looking at those things like HIPAA releases. If you're a family of enough wealth that's done a bunch of planning and moved assets out of your balance sheet and onto your kid's balance sheet, and something happens to your kid, as much as I hate to say this, because none of us want that to happen, but these things do happen. If that child dies intestate, those assets go right back in most states to the parents. Well, that's probably the last place you want them going, right? You're really trying to bring those assets to their siblings or to other family members or wherever they're going. So, you've got a lot of different things like that are, sorry, I screen changed on me.
No, that's okay.
Things like that, and then I'd say this general failure to prepare heirs is kind of another big one.
Right. I guess to reiterate what you had mentioned before regarding, that you may have, to getting the financial literacy and the education around that for yourself, for your partner, for your children. Any closing thoughts on that?
Closing thoughts on it, I'd say, would be, don't underestimate how important it is, and that it's relatively easy to get, and because you're not trying to make everybody experts again in every situation or in every topic that I would include in that idea of financial literacy. So, bring your advisors in. One, because they get to know your family. I mean, your advisors ought to be asking to do that anyway, because they want to keep you as a client and they want to keep your heirs as a client. But make sure that you're using those resources that are available to you. Bring your estate lawyer in to talk to your family about how trusts work. Bring your investment advisor in to talk about diversification and asset allocation. Bring your insurance person in so that it's not mom or dad dictating to everybody. It's bringing these experts in. It's letting your family get to know them. And go find, depending upon your family situation, honestly, but go find the me's of the world who are out there, working with families and talking to families about governance and education and dynamics, and they'll be able to help guide you through that.
Great. That's it. I don't have any other
Awesome.
questions here. Anyone else?
I think we did have one last question. I'm sorry, I just got this one. If someone wants to get started on creating a family owner's manual, can you tell a little bit about resources that they could access to get started?
Yeah, absolutely. It's, you can start as simple or as complex as you really want. There's lots of ways to start. I'd say, reach out, again, same group of people in some sense. Reach out to your estate planning lawyer, ask them for a checklist. Reach out to your investment advisor, ask them for a checklist. Reach out to your insurance agent, ask them for a checklist. If your family's working with, again, somebody like me, ask them how they approach this. There's a number of books. There are a number of really great books out there about this kind of idea of legacy planning and I will say they're mostly checklist based. And I think the problem with the checklist based is getting beyond that, right? One of the things that we're creating Leaf Plan about is to try to get what I keep saying is past the what and where and to the how and why. And I do think that's important, but I think you can self-guide yourself through that, or you can use your advisors to guide yourself through that, or find a more comprehensive solution. But there are lots of different ways to get started with that. I mean, you can start with an Amazon search or, again, those calls to your key advisors.
How long do you think something like that would take the average high net worth family?
It depends. Yeah, it depends on how organized people are to begin with and what level of detail they want to go into. I find that if you ask people,
42 months?
it'll take less than 42 months. But I would say, I view it as an ongoing process. And so, the one I've created for our family has been a 20-year process, and it gets updated constantly. So if there's a new transaction, a new advisor, a new change to the way we keep our data or whatever, but it becomes obviously much more routinized and much easier to keep that up to date. The initial input of time it's pretty significant. I mean, you're probably going to spend 20, 40 hours over the course of a year putting this together the first time, depending upon how organized you are and how you want to put it together and what kind of tools you're using to put it together. But chances are, you're talking about printing out contacts out of your Outlook contacts, right? Or your Gmail contacts. A lot of this information exists. And I typically will tell people, don't recreate the wheel. And what I mean by that is if you already have all your documents in Box or Dropbox or, on your computer, just tell people that's where to find them. Like you don't need to necessarily recreate and move into a new system or a new way of doing things. You need to just give people the tools to understand, again, what's kind of in your head. I know what my file structure looks like on my computer, but nobody else does, and it's not going to make sense to them. So for me to be able to give them that instruction is more important than taking all the time to redo my whole system.
Thank you so much. I don't think we have any more times for questions, but if any of our participants do have a question, go ahead and leave that in the chat and we can reach out to you if you have any other input for us. I want to thank both Daniel and Josh for being here today. Thanks to the organizations who have made this webinar possible, and thanks to our attendees for attending. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. So find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming. We'll see you in another webinar soon. Goodbye, everyone.
Thank you. Bye-bye.